Hi, it's Vincent Mancini, your Ironman Realtor, with my good buddy, Mr. Licorice, and our special guest today, Drew Whipple, the Mortgage Whip. And our question today is, how much house can I afford? So today we brought in a mortgage professional, Mr. Drew Whipple, to help us with our question, how much house can I afford? I know this is probably a question you get all the time.
Yeah, Vince, it's one of those questions. It's actually one of the number one rated Google questions out there as well, and especially for those first-time home buyers. They want to know how much they can afford.
So what can you tell our friends, our viewers?
So there's really like three different components with how much they can afford. Number one is the debt-to-income ratio.
That's important.
The number two is the interest rate.
Sure.
And number three is the actual purchase price.
So why don't we, again, it's a big topic here, why don't we dive into each one individually? So debt to income, like what would you tell our viewers?
Sure. Basically, the debt-to-income ratio is a very basic mathematical equation. It's taking all of your monthly debts, so that's your credit cards, your student loans, your short-term loans, whatever you might have, plus the principal, interest, insurance, and if there's an HOA on the proposed house. You take all that monthly, that debt, and divide it by the monthly income. And it comes up with a ratio. Okay, now there's certain programs that allow higher ratios and other programs that are a little more restrictive. So basically what it means is how much of my income is going to be used toward debt, okay? And with FHA, you can go up to a back ratio of like 56%. So meaning that 56% of your income can go toward debt, okay? Well, on the conventional side, you want to be below 50%.
Okay, that's a lot there. So the next piece, the interest rate. I would think that's another question you get all the time. Hey, what's my rate going to be?
Yeah, so the rate is going to be based on many, many factors. Number one is your credit score. The higher the credit score, the lower the interest rate. Okay, that's the goal, is to get the lowest interest rate possible. Right now, we're in an environment where the rates are climbing. Okay, so one of the most important things is when you're getting pre-qualified, you want to make sure through the rate environment increase that you still qualify. So there's been clients that are, their ratios are pretty tight. And if that rate goes up to maybe 1/4 to 0.5%, so I'll give you an example, like on a $300,000 house, it goes up by 0.5%. That's like another $80, $90 added to the monthly payment. They might not qualify.
So the final piece, the purchase price. And I know in today's market, it's a little crazy. People are overbidding. And I know I have clients that may have lost something by 10, 15,000. But I mean, what does that really mean at the end of the day?
Sure. Obviously, the purchase price right now with the environment that we're in, we have to really educate our buyers to make sure that they realize that $10,000 is only going to change the payment by like $30, right?
That's it, $30.
Right, that's it.
A month.
So I tell my clients, stop buying Starbucks coffee every day, maybe go to Dunkin' Donuts, a little cheaper. So that $30 will get you in your dream home. People are losing homes by $10,000, $15,000 over a 30-year payout. It's crazy. So we really have to educate our clients to understand that it's buying that a little bit more expensive home gets them in the house for a little bit extra payment.
Fantastic. Well, there you have it. If you have any questions about how much home you could afford, please contact Drew Whipple, the Mortgage Whip. His information is below. And if you have any questions about real estate, don't hesitate to call me. Thank you so much for watching, and have a great day.
Thanks, guys.